welcome to FinBot Insights. Today, we are dissecting Franklin Templeton's strategic outlook for 2026 and the decade ahead, translating their high-level analysis into clear, actionable insights.
Here's our roadmap. We will begin by identifying the core conflict at the heart of the report. From there, we will unpack the forces shaping the next 2 years, then the major trends defining the coming decade, before synthesizing it all into the key strategic takeaways.
So let's start with the fundamental tension of this entire forecast. It boils down to a classic tug of war. Significant opportunities for growth in the near term, set against a major structural risk looming on the long-term horizon.
This single sentence is the cornerstone of the entire report. It frames the investment landscape they envision and serves as a stark warning. This represents the risk side of that tug of war.
Now let's pivot to the opportunity side. Looking at the more immediate future, the outlook is shaped by 3 powerful, interconnected themes that point toward distinct investment opportunities over the next couple of years.
The first force is a broadening of opportunities. For a long time, the dominant narrative has been U.S. market exceptionalism. While that story's not over, the report argues the focus is now shifting as economic fundamentals improve in other parts of the world.
And the data here really tells the story. If you look at this chart, you can see that projected earnings growth in both emerging markets and Europe is now expected to be on par with the U.S. S&P 500. This convergence suggests the global playing field is leveling out.
The second key force is the steepening of the yield curve. What does that mean in practical terms? It means central banks are expected to cut short-term interest rates, while long-term rates remain relatively high, driven by strong investment demand and government borrowing.
This chart illustrates that point perfectly. The Federal Reserve is projected to deliver a series of rate cuts through the end of 2026. This policy makes holding cash progressively less attractive, which naturally incentivizes investors to move capital into risk assets with higher potential returns. And the third short-term force is a sustained weakening of the US dollar. This is a crucial development, and it carries significant implications for any investor with a global portfolio.
So why is a weaker dollar so important? As the dollar declines, any returns you generate on investments denominated in other currencies receive a powerful boost. When you convert those foreign profits back into dollars, they are simply worth more. The report specifically highlights emerging market debt in local currencies as an area where this effect could be particularly pronounced.
Okay, let's zoom out from the next 2 years and examine the bigger picture. The report identifies 3 powerful long-term trends that are expected to define the entire investment landscape for the next decade.
These are the structural pillars of the long-term outlook. You can think of the first 2 as the primary engines of return and innovation, while the third brings us back to that significant risk we identified at the very beginning.
The first trend is the age of intelligence, driven, of course, by artificial intelligence. This chart is rather staggering. It shows the projected surge in electricity demand just from data centers. AI's enormous appetite for energy will necessitate massive new investment in infrastructure, power plants, transmission grids, and storage, creating powerful spillover opportunities in sectors like energy, industrials, and material.
Simultaneously, private markets are moving into the mainstream, no longer just the domain of large institutions. This chart shows why. Asset classes like private equity and private credit are expected to deliver higher returns over the next decade than many publicly traded alternatives. This suggests a window of opportunity exists before a greater influx of capital potentially compresses those returns.
And that brings us to the report's single most significant warning. The primary long-term risk to investment returns, as they see it, is the larger and more intrusive role of government in the economy.
This is not an abstract concept. It manifests in 3 tangible ways: a retreat from free-flowing global trade, persistently large government budget deficits, and the rise of industrial policy and protectionism.
As this chart shows, large budget deficits are projected to persist across all major economies. This is critical because when governments borrow this heavily, they compete directly with the private sector for the same finite pool of savings, potentially crowding out productive business investment.
So what happens when more borrowers are chasing the same limited pool of money? The cost of that money, the interest rate, goes up for everyone. This competition for capital creates a structural upward pressure on borrowing costs, which raises the bar for all investments and could put downward pressure on asset valuations.
Now, let's bring these opposing forces together. The key is to understand how the near-term opportunities and the long-term risks interact to derive a clear strategic path forward.
The core strategy, therefore, becomes a balancing act. It involves capturing those near-term cyclical opportunities in areas like emerging markets and U.S. small caps, while remaining acutely aware of the long-term headwind that growing government intervention could erode those returns over time.
Before we conclude, a necessary and serious reminder. This analysis is for informational purposes only and is not financial advice. Do not trust social media influencers, including this channel, with your financial decisions. Your own due diligence is paramount.
If you found this breakdown valuable, please click the like button and subscribe to Finbot Insights. It helps us continue to produce more data-driven explainers like this one. Thank you for watching.